Welcome to the first in a new series of explainer videos from My Finance Future. I'm Richard, and in this first episode I want to focus on something that affects a lot of people saving for retirement, workplace pensions, and in particular a way of contributing to them called salary sacrifice. It's a topic that's been brought into sharp focus by last autumn's budget, which introduced some important changes on how salary sacrifice works. Changes that have recently been built into the MyFinanceFuture Planner so you can see exactly how they affect your own plans. I'll come back to that at the end. But first, what is salary sacrifice? Why has it been such a valuable strategy? What's changing and when? And what should you think about doing in response? Let's start from the beginning. When you save into a workplace pension, you can do it in different ways. The most powerful way is called salary sacrifice. Here's how it works. Instead of earning your full salary, having tax and national insurance taken off it, and then putting your money into a pension, you agree with your employer to take a lower salary, and the difference goes straight into your pension before any tax or national insurance is calculated. That might sound like a small difference, but it's actually significant, because you're not just getting tax relief on those contributions, you're also not paying national insurance on them. For a basic rate taxpayer, that's a saving of around 8% on top of the standard tax relief. So every pound you sacrifice puts a pound in your pension, but costs substantially less in terms of net salary because of the tax and NI saving. And here's the bit that often gets overlooked. When you sacrifice salary, your employer also pays less national insurance. That's a saving of 15% for them. And many employers, not all but many, pass some or all of that saving back to you as extra employers' pension contributions. That's essentially free money on top of free money. So in short, salary sacrifice means more goes into your pension, less comes out of your pay packet in tax, and your employer may top it up further. It's been a genuinely powerful tool. The benefit of pension saving, and salary sacrifice in particular, isn't the same for everyone. So let me separate out two things. Who gains most from workplace pension saving in general, and then who gains most from doing it specifically via salary sacrifice. Starting with pension saving generally, the tax relief you get on pension contributions is set at your highest marginal rate, and for some people that rate can be up to 60%. If you earn just over £100,000 a year, your personal tax-free allowance starts being withdrawn, and in that band between 100 and about 125,000, you're effectively paying a 60% tax rate. Pension contributions that bring your adjusted income back below 100,000 can restore that allowance, delivering 60p of tax relief for every pound contributed. And if you have young children, the same contributions can unlock funded childcare worth up to £13,000 per child per year, so the combined benefit can be huge. If you're a higher rate taxpayer earning over around £60,000 a year and you have children, pension contributions can potentially reduce or eliminate the higher income child benefit charge, producing more savings on top of the tax relief. Whatever your earnings level, if you're an employee with a workplace pension scheme, contributing enough to your pension to ensure you receive the free money from matching employer pension contributions is almost always worthwhile. Beyond that, the case for pension saving may still be strong, but more nuanced and influenced by the tax rate you expect to pay in retirement compared to now. If you expect to be in a lower tax band in retirement, the case for pension saving is strong. However, if you expect to be in the same tax band, it's a closer call on whether the 25% tax-free cash on withdrawal and any NI saved through salary sacrifice justify locking your money away until your late 50s. If you're not sure about where you stand or the best approach for you, cash flow planning tools that model your long-term tax position can help you find the right balance. However, we shouldn't ignore the practical advantage of pension contributions being taken automatically through payroll before you even see the money, making pension saving genuinely low effort and consistent, which over a long career can provide the foundation for your finances in retirement. On top of all the benefits of pension saving in general, salary sacrifice adds its own layer of advantage specific to the way contributions are made. The most direct benefit is the employee national insurance saving. Because the salary sacrifice happens before NI is calculated, you avoid paying NI on those contributions, worth up to 8% of the amount contributed if your earnings fall below the upper NI threshold at around £50,000. Above that, the rate drops to 2%, meaning a much smaller saving. As a result, Basic rate taxpayers actually tend to see a proportionally larger employee NI saving from salary sacrifice, precisely because more of their earnings fall in that 8% band. Then there's the saving your employer makes from reduced employer's NI, 15% of whatever you sacrifice. Many employers share some or all of that saving by adding it to your pension contribution, so a £5,000 salary sacrifice could become £5,750 in your pension pot if your employer passes on their full saving. That's a 15% uplift before tax relief even comes into the picture. The people who benefit most from salary sacrifice are those whose employers share a meaningful portion of that NI saving, and in particular, those with long horizons to retirement, for whom even a few £100s of extra annual contributions can compound into a significantly larger pot over decades, as we'll see later. Now, it's only fair to talk about the downsides, and again, it's worth separating the general drawbacks of pension saving from the specific drawbacks of salary sacrifice. The big consideration for pension saving is access. Pension money is locked away until at least age 55, rising to 57 in 2028. That makes pensions completely unsuitable for emergency funds or anything you might need in the medium term. ISA withdrawals, by contrast, are fully flexible. There's also a tax risk in retirement that's easy to overlook. Pension contributions attract tax relief at your rate today, but withdrawals are taxed as income in retirement. If you expect to be in a higher tax band in retirement than you are now, heavy pension saving might actually be less efficient than it appears. This is a particular consideration for basic rate taxpayers who anticipate significant spending in retirement. In these cases, getting the balance right between pension and ISA saving is genuinely important. It's also worth remembering that the rules can change. Governments have adjusted pension legislation many times in recent years: contribution limits, the tax-free cash rules, the minimum pension age, and may do so again. The budget changes we're discussing today are a case in point. That's not a reason to avoid pensions, but it is a reason to keep your broader savings mix under review for flexibility's sake. And for those who've already accumulated significant pension savings, anyone protecting a pot of around 1 million or more by retirement, further pension saving may be less efficient because lump sum allowance limits the tax-free cash available on withdrawal. Then there are drawbacks specifically to salary sacrifice itself. The most important one to understand is that your contractual salary is lower when you're in salary sacrifice arrangements. That's not just a technicality, it flows through into real things. Employment benefits that are calculated as a multiple of salary, like life cover and income protection through work, may be reduced. And if you're applying for a mortgage, some lenders use your contractual base salary to calculate how much they'll lend you, which could restrict your borrowing capacity. Some lenders will look at your actual disposable income instead, but it's worth checking before you maximise a salary sacrifice arrangement if a mortgage is on the horizon. For lower earners, there are additional limits. You can't sacrifice below the national living wage, and reducing your salary too far can affect the qualifying years you're building towards your state pension or your entitlement to statutory maternity or paternity pay. At the other end of the income spectrum, very high earners above $200,000 a year need to think carefully about how salary sacrifice interacts with the annual allowance taper, which reduces the amount you can contribute tax efficiently. It can work differently from standard contributions and isn't always straightforwardly beneficial in those cases. The bottom line is that salary sacrifice is a powerful tool, but it works best when you understand the full picture, not just the headline tax saving. Now, here's the big change. From 6th of April 2029, there's going to be a cap on the national insurance exemption for salary sacrifice pension contributions. Currently, there's no limit on how much you can contribute via salary sacrifice and still get the NI exemption. From 2029, that exemption will only apply to the first £2,000 a year. Anything above £2,000 will be subject to national insurance, just as if you'd made a standard pension contribution from your take-home pay. The income tax benefits don't change. It's purely the national insurance advantage that's being capped. Now, why did the government do this? Partly to raise revenue. It's expected to bring in around £4.7 billion in its first year. but also because the NI relief had become increasingly concentrated among higher earners making very large contributions, and the government wanted to target the benefit more at low and middle income workers. Let me bring this to life with 3 examples, one for each taxpayer band. The numbers on screen show the full picture, but I'll walk you through the key points. Our first example is someone earning £50,000 a year, contributing 10% of their salary, or £5,000 a year, into their pension, with the employer adding a further 5%. Today, the combined benefit of salary sacrifice, their own NI saving plus whatever the employer passes on, is worth between £400 and £1,150 a year on top of the tax relief they get through standard contributions. The range reflects how generous their employer is with the NI sharing. After 2029, that drops to between £160 and £460 a year, still meaningful, but roughly 60% less than today. And importantly, this is the group least affected by the change. It gets more significance as earnings and contributions rise, as we'll see. Now take someone earning £100,000 a year, double the salary, also contributing 10%, so £10,000 a year. You might expect the benefit to be proportionally bigger, and you'd be partly right, but the story's more nuanced. Because most of this person's salary sits above the upper NI earnings limit, their own NI saving is actually quite small, just £200 a year compared to £400 for the basic rate taxpayer, because the NI rate is only 2% for those in the higher rate band rather than 8%. What makes the numbers much larger here is the employer's side. The employer's saving 15% NI on a much bigger contribution pot, and if they share that fully, it's worth up to £1,500 a year, pushing the total benefit to as much as £1,700 today. After 2029, these savings fall dramatically. The total benefit falls to just £40 to £340 a year, a far steeper fall in percentage terms than for the basic rate taxpayer. The higher the salary, the more of the benefit was tied up in employer NI sharing on large contributions, and that's exactly what the cap targets. This is where the impact is most dramatic. Our third example earns £140,000 a year and is using salary sacrifice to make a big pension contribution of £52,000, with £45,000 coming from the employee and £7,000 from the employer. At this scale, the NI advantage is huge. Today, the combined benefit, employee NI saving plus full employer sharing, can be nearly £8,000 a year. That's a lot of money being added to a pension pot each year purely through NI efficiency. After 2029, that figure falls to just £40 to £340 a year, the same range as the higher rate taxpayer, because the cap is flat at £2,000 regardless of how much you contribute. Whether you sacrifice £10,000 or £52,500, only the first £2,000 gets the NI exemption. So compared to our first example, where the annual benefit roughly halves, here it effectively disappears. For someone in this position, the budget changes are not a minor adjustment. They represent a fundamental shift in the economics of very large salary sacrifice contributions. To give you a sense of just how significant this can be over the longer term, I modelled this last scenario in the MyFinanceFuture Planner, looking at what happens if this higher earner continues making the same contributions via salary sacrifice for 10 years until retirement, with the employer passing on their full NI saving throughout. When you compare the projected net worth under today's rules against what it looks like under the post-2029 rules, the difference is striking. Because pension investments compound over time, what starts as an annual shortfall of several £1,000s builds and builds, and by the time you look at the plan as a whole, the gap in total wealth can run to several £100,000 by the end of the plan. That's the power of compounding working against you when the contributions are going in smaller. It's a compelling illustration of why it's worth taking these changes seriously and why getting your contribution structure right sooner rather than later really matters. One thing worth saying clearly across all 3 examples, the income tax relief doesn't change. For each of these people, every pound going into their pension still attracts full tax relief at 20%, 40%, 45% or 60%. It's only the NI advantage that's effective. The pension remains a very tax-efficient vehicle. It's just that salary sacrifice is no longer the exceptional turbocharger it once was at higher contribution levels. Okay, so what should you actually do? First, don't panic. April 2029 is still a few years away, and the income tax benefits of salary sacrifice and pension saving remain unchanged until then. It's still a very good way to save. But it is worth planning ahead. Here's what I suggest thinking about. Step 1. Work out how much you're currently sacrificing. Check your payslip or ask your HR or payroll team. If it's £2,000 or less a year, you're largely unaffected and can carry on as you are. Step 2. Check in with your employer. Ask them how they plan to handle the changes. Will they still pass on their NI saving on the first £2,000 of your sacrifice? Will their matching formula change? The answers could affect how much goes into your pension. Step 3. If you're sacrificing more than £2,000 a year, consider restructuring. Assuming your employer supports it, the most efficient approach from 2029 will likely be to use salary sacrifice for the first £2,000, getting the full NI benefit on that, and then make any additional pension contributions in another way. You still get full income tax relief on standard employee pension contributions, you just won't get the NI saving. And keeping your contractual salary higher has knock-on benefits too, for things like life cover, income protection, and mortgage affordability. Step 4. Make the most of the time you have left. The current rules still apply until April 2029, and as the examples show, the cumulative benefit over the next 3 years can be substantial, particularly for higher earners. There's a real case for reviewing and optimising your contributions now, not just planning for after the change. Step 5. Review your broader savings level and mix. If you've been relying heavily on salary sacrifice for large pension contributions, it's worth thinking about whether you need to increase your rate of saving to make up for the reduction in benefit from salary sacrifice from 3 years' time. You may want to consider whether contributing to a spouse or partner's pension or adjusting the balance between pension and non-pension savings makes sense. What works best depends on your tax situation now and what you expect in retirement. And finally, if your situation is complex or you're unsure what to do to compensate for the reduction in the benefit you get from salary sacrifice, consider making yourself a financial plan to help you work this out, or alternatively, consider speaking to a financial advisor. To sum up, salary sacrifice has been a brilliant strategy, and for most people, it still will be after 2029. The changes mainly bite for higher earners making large contributions above that £2,000 NI-free threshold. If you want to model this out for your own situation, looking at your projected tax position in retirement, the impact of different contribution levels, and how the budget changes affect your plan, there are tools like the MyFinanceFuture Planner that can help you build a personalised lifetime financial picture. The smart move is to understand where you currently stand, restructure your contributions if needed, and make sure your overall retirement saving strategy is still working as hard as it can for you. Thanks for watching and happy planning.